Dividends. So dividends are paid from present and past earnings. Well, where are present and past earnings, present and past net income stored? They are stored in retained earnings. Boom, that's what they're paid for. Dividends can be restricted based on liquidity and solvency tests. So, yeah, paying out cash to your shareholders to reward them for holding your stock is great and all, but if you can't afford it and you're not liquid enough, and it could potentially put you under because you're paying out too much in dividends, then there are restrictions on that. There are restrictions because the company, or they don't want you to pay more than you can, so they restrict certain CEOs from paying out too much. Types of dividends. So cash dividends, the most common, right, that you hear about. You get paid 50 cents a share. Property dividends, a lot of this might happen more with a smaller company, right? So like if you own your own business or a smaller company and you want to pay yourself out through like a truck that the company bought, and you buy the truck to the company and then pay it out as a property dividend, you could do that. Stock dividends, this is maybe Tesla doesn't want to pay you in cash, so they give everyone an additional extra share for every share you're holding. Liquidating dividends, this is when the company's going under and they give out the net assets, the remaining liquid balance of the company, as a dividend. All right, so dividend dates to memorize. This is the dividend process. So we've got the declaration date. This is important because dividends are declared and accrued, they're accounted for. This is when they become official, they're on the books, that we are going to owe money to the shareholders. And there are going to be journal entries in each case. So the declaration date, we debit dividends and credit dividends payable. And as a note here says, debit can be to dividends or to retained earnings, because at the end of the day, it is coming out of retained earnings. You are reducing your retained earnings, just different ways that the journal entries could display it for you. The ex-dividend date is important for the investors, not so much the company, because whoever's holding the stock as of this date gets the dividend. So the company's paying it out regardless to each share. They don't really care who the person is that they're paying it out to. So that's important for the investor, not for the company. And this is from the company's perspective right now. The record date. So this is when you have the list of stockholders to whom the dividends are to be paid is finalized. This is the least important. There's no journal entry. Nothing really happens here, just so you kind of know the process. And lastly, the payment date. It's pretty important, right? This is when cash is actually paid out. So this is where you are going to debit your dividends payable and credit cash. So the net effect with all of this is that you're essentially debiting retained earnings or dividends. It really would be retained earnings more so in the exam. I just have dividends here and have a note to that as well. So yeah, the net effect, the dividends payable cancel each other out. You're really just debiting retained earnings, crediting cash. It's just an intermediary journal entry. Property dividends, like I said, these are not cash. Property dividends are assets payable from the company to the shareholder. It could be land, it could be building, it could be truck, it could be anything. They are non-reciprocal transfers between the corporation and shareholders, meaning non-reciprocal, only one party is giving something up. That's the company giving up something to the shareholder. They're valued at the fair market value of the assets distributed at the time of declaration. So if the truck is worth $10,000 as it's being distributed as a dividend, then yes, the value of the dividend will be at $10,000. And lastly, there is a gain or loss recognized by the company on the distribution of the assets, just like if we go back to our PP&E section. When you get rid of an asset by selling it or disposing of it, there's a gain or a loss to be recognized. Stock dividends. Well, we've got large stock dividends and small stock dividends. So stock dividends, as we said with the Tesla example, they give shareholders stock instead of cash. Why? Again, maybe you just don't want to give out cash. You're a little cash strapped at the moment, but you do want to reward investors. So you give them some stock. Now, just two rules. If you are issuing under 20 to 25% of the stock, how do you account for that small stock dividend? Well, it's at the fair market value of the stock issued. If it's a large one, so you're distributing over 20 to 25% of the stock, that's going to be accounted for at the par value of the stock issued. Don't worry about it too much. They'll tell you if it's a small or a large. They're not going to nitpick you too much there. Just more accounting points to keep in mind. And what about those journal entries? So when the stock dividend is declared, just like when we are dealing with normal dividends, we are debiting retained earnings. We're reducing that. We are crediting our common stock dividend distributable because that's what you're giving up. You're issuing more stock, essentially. You're creating more. So you're increasing equity there. And as we saw before, paid in capital is our plug. What about when the stock dividend is distributed? Well, common stock dividend distributable and then common stock. So this is like the payable, what we saw for dividend payable, same concept there. What about stock dividends versus stock splits? Stock splits, this is when, why would a company do this? Well, they want their stock individually to seem like it's cheaper because investors a lot of times don't look at the market cap of the company, which if a company's worth $100 billion, that doesn't change regardless of how you manipulate your stocks. So if it's worth $100 billion, then regardless, of how many shares, like you can double the amount of shares, but each share will then decrease in value to half. Now, individually, you still have the same value in your portfolio, but it seems like each share is cheaper. So, I mean, in 2021 or 2020, I personally don't remember, but both Apple and Tesla did that. So everyone's like, oh, their shares are cheaper, I'm going to buy more. Or, people who can't buy fractional shares, they can now buy those full shares for cheaper because they don't want the stock to be like over $1,000 because that seems pretty pricey for people. There are different strategies for that. Like Amazon wants their shares to seem like they're crazy expensive. There's just different strategies and reasons why. So with the stock split, you are just increasing the amount of shares, but keeping the market cap the same because the value of the company is still the same. Stock splits do not require journal entries, as it says, because nothing's really happening. You're just doubling the amount of shares and halving the price of each share. So the total value of the company stays the same. Stock dividends, the par value of a share does not change. Total number of shares increases, right? Because you're issuing more shares now for those stock dividends and increasing the amount outstanding, so diluting. Total stockholders' equity does not change. The composition of equity changes, so less retained earnings and more of stock. And stock dividends require journal entries, which we just saw.